Thanks, Jim. Good afternoon. Behind me, there's going to be a scroll, and there's not an absolute correlation to my remarks, so bear with me and have fun with the scroll, but otherwise, I do hope you'll listen. It's safe to say that the financing world has had a terrific year, both debt and equity, and certainly here in Boston, we've been the great beneficiary of this. You've heard it. You'll hear it again in a little bit from Doug. Cap rates are low, values are enhanced, approval processes with institutions have become streamlined, and lenders and equity sources see Boston as a favored nation status. And obviously, as been hit before by John Fish, the Olympics has given us a platform on the international stage. It wasn't always that way, and some of us can remember back when. But today, we're blessed to be here. I only hope to see this extended deeper into New England, that the rest of New England enjoys the benefits. We're today doing deals in Portland, New Haven, Hartford, Providence, and certainly following our clients across the country as needed are there. And I don't see storm clouds. We're in a good climate and a healthy market. I'd like to take a moment, though, and look at the various lending sources that we deal with and offer some perspectives through our prism. Life companies, firstly. Interest-only opportunities are there. 12-year money is virtually the same price as 10-year, making an easy way to buy 2 additional years of rate protection. Prepayment penalties on the back end of deals for modest add-ons of perhaps 10 basis points over what we know to be today's extremely low rates provides you with 2 years open end as opposed to the traditional 6-month open end. An observation as you look forward in this market. Forwards were traditionally 90 days free. We're seeing out to 120, even 180 days. And on to-be-builts on the forwards, we're seeing, which were 4 and 5 basis points, if you could find a forward, are dropping to 4 and 3 basis points for that same privilege. Yield maintenance situations where lenders can be persuaded to add 75 basis points to the discount rate, thus reducing your penalty. Again, something to keep in mind. If defeasance is an option, take it. Rising rates will be accretive in these scenarios, and the penalty will wrap into the new loan. Environmental policies, insurance policies are being used as protection against recourse indemnifications. While I suggest life companies can do 70 to 75%, in my eyes, their best execution is the 60 to 65%. It's the best place for breakpoints and rates and execution. Traditionally, 25 to 30-year amortizations are the way to go, but again, we're seeing interest only from 3 to 5 years on an as-needed basis, as negotiated basis. Obviously, non-recourse par loans. Size is no barrier for institutions. Insurance companies last year did nearly $360 billion, a healthy year. Spreads right now, as low as 130 to 200 over, but with low treasuries, I do worry that we're going to see, and maybe it's a commercial for my insurance friends, perhaps floors setting in, but they're only going to be as good as the competitive market deems them to be there. So the first 6 months we might see them, then I think they'll break back open. So these are a couple of observations on life companies, and again, it's our job to bring that wisdom and advice to you as we work with you. CMBS loans are back and continue to be an aggressive, strong source for loans. Historically, CMBS lenders were not as consistent as banks or life companies. In fact, the product really came into fashion approximately 10, 12 years ago, where they did about $92 billion in 2004. 2008, during the downtime, they did $2 billion. We thought they were out of business. Last year, they came back with $115 billion and expect in 15 to be well north of that. And again, they are also a very strong interest-only lender. Portfolios are clean, streamlined process, very aggressive execution, and they're a lender who, the issue with them is you just want to make sure that they're with you during the good and the bad days of the loans. And an observation as banks deal with Dodd-Frank and capital adequacy, which is their watchword and their concern, CMBS has the overhang of rating agencies. In fact, only the last couple of weeks, Standard & Poor's has stopped rating CMBS paper. Thus, I can anticipate some backlog in that channel. On Freddie and Fannie, good source for rates, very competitive. Again, a personal opinion, I think we have to watch what's going to happen in Washington. I suspect Freddie Fannie will always be there for single family, just as America's dream. But as far as multifamily, I don't know. There's going to be pressure continue to be brought, but as they're in business, they're a great source. Banks. Banks are competing as term lenders. 30 years ago, we all knew them as construction lenders, short-term lenders. Today, they're doing 10-year deals, generally lower loan-to-values than life companies, but they're very relationship sensitive and will go the extra mile to capture well-underwritten, low loan-to-value loans. They're competitive with rate and term and are generally some modest level of recourse, but they're not generally a non-recourse lender. Banks is the ability and observation to play the delta between benchmark indices with swaps and realize significant savings. By example, 5-year loans, I might take advantage of the LIBOR rates. They're so low right now, 0.17, and a very modest 200 spread competes very well with a fixed rate swap of over 3%. So my recommendation is on your short loans, that's a good source to stay short. 10-year deals, I wouldn't swap it out for the full term. I'd execute a 7-year swap, and it worked very well for a client this year where we saved them some 50 basis points by doing 7 versus 10. Savings banks, terrific lenders, $5 to $40 million. There are many of them in the room and many in this area. They're great for basic fundamental office and condominium loans. And I think condominiums, in my eyes, are going to be very necessary as Ron and my partners have used the term millennials. I didn't know what this meant a couple of years ago, but I guess I want that world. But I think if we're going to keep these kids in the city, ownership is going to be critical and not just apartment living. With respect to product, I think my partners have carried it well. It's a strong market. It's a product that any of our lender friends would like to do. I don't think there's any negative product in Boston, hotels, office, et cetera. This year, next year I anticipate a strong year for refinancing, and we'll be spending more time on joint ventures. We were involved in several last year, and equity sources are becoming more involved in looking at overall returns of low to high teens, depending on core versus opportunity. And in fact, we were involved in one deal this year where the equity partner was able to recognize the imputed value of the land versus the actual acquisition. We were able to do it was at 40% equity, and the borrower was able to capture a non-recourse construction loan on a spec apartment deal in Connecticut. So with right equity and the right structure, it's an attractive time to be borrowing. The other product that we did this year was so-called Schedule D. We did it with a Prudential deal where we took the credit of the tenant and treated it as a lease, as a bond, rather than a real estate play, thus capturing 100% money for the client, 100 cents on the dollar of his cost. And again, you're using the credit advantage, and several of the partners have talked about build-to-suits. If the credit is there, it might be another source. I'm optimistic that rates will stay low. The Federal Reserve Bank, obviously, we all read, is under pressure. I think Jimmy or Joe made reference of the international situation. I do worry about where Europe fits in the scheme of things on the European Central Bank and their rates, but on balance, we're obviously in very good shape. And lastly, our capital markets group was blessed this year with the addition of Doug Jacoby, Scott Dragos, and the rest of their investment brokerage team. It brings a great addition. It gives us new opportunity, opening up financing world with the transactions that these people will be doing. And it's my pleasure to introduce Doug Jacoby this afternoon. Thanks, Doug.